Hi everyone, welcome back to Mike's Minutes. My name is Mike Dunn, a wealth advisor with IPC Securities. Thank you for tuning in to the year-end video. I'm sure a lot of us are excited to put 2020 behind us and look forward to 2021 and hopefully an end to this virus. But I want to say thank you for tuning in to the year-end video, and I want to remind you that the information that I present in these videos is strictly for educational purposes. It's not intended for advice, and everybody's situation is different. So also, if you haven't subscribed to my channel, please do so so you can be updated on new content as I post it. So in this video, I basically just want to reflect on the year, provide some thoughts and what I learned as an advisor and also what I learned as an investor. So for lack of better terms, and to say the least, this was probably the most interesting year, generally speaking, that most of us have ever gone through. If somebody lived under a rock and emerged in the month of December, even the month of November, they wouldn't really know that a pandemic was going on from a market perspective. I mean, you see people wearing masks, lineups at grocery stores, things are closed that are usually always open. But from a strictly a market perspective, you just look at where we are, and we've surpassed where we were before the pandemic even started. So a lot has obviously changed in many aspects of our lives, but when it comes to investing, this year definitely highlighted some of the key concepts that can help you build wealth over time. My message to a lot of my clients and to anybody I talk to is very, very consistent. And you'll notice throughout my videos that a lot of simple pieces of investing tips or just educational purposes, it's very boring. I mean, I'm not giving a latest and greatest stock tips. That's just not how I manage client money. But a lot of the common themes are very consistent. And this year was no different than any other year, even though we went through a global pandemic. So some of the key concepts that were highlighted this year would have been stay invested. I say that at the end of every video. Don't get emotional, contribute often, and those are for those who are in the savings phase of their life, and know your risk. I never advertise myself, like I said, as a stock picker, and I hope you don't either, because it is never easy to pick individual stocks. When you have control over your investing, it's very easy to make emotional mistakes. So this year, and I would imagine some of the performance of the market is the angel investor. A lot of people are at home and day trading. Day trading, you might hear about some stories, but let's be honest, if it were that easy, I wouldn't have a job. You probably wouldn't be listening to this video. We'd all have loads and loads of money, and my sector or industry may never exist. So it's not very easy, but when you have control, it's very easy to make a mistake. It's very easy to panic, get emotional, and probably make a poor decision. So let's get back to February of this year. So February 19th, for example, to March 23rd. The S&P 500, the big US index, dropped 34%. So that span of time, the entire S&P 500 was down about 34%. And that's obviously from pandemic panic, say that 10 times fast, pandemic panic, and uncertainty really that would come, or that we just didn't know. The markets get spooked when we don't know what's going to happen, right? I'm sure just as human beings, that's very common. No one really knew where the markets were going, what was going to happen, how bad this virus is. There was just a lot of unknowns. And when there's a lot of unknowns, the markets get spooked. Hence, we saw such a big drop in a short amount of time. As the year went on, we became more educated on the virus. and what it means to us, and things started to turn around. So the S&P 500 gained all of its losses in around 5 months. So it gained everything back in almost 5 months, and has gained about 64% in 8+ months. So that would be kind of the beginning of December. Markets are even higher now, but some data that I looked at was roughly in the first week of December. So regardless, you can see a drop of 34% and then up 64%. So that is a big swing in 1 year. But let's be honest, none of us really have seen this type of situation. I mean, we've seen pandemics, we've seen viruses, but to this magnitude, most of us just really haven't gone through this. So, if you owned quality investments, so, that's a very subjective word, quality. But big companies that they're not just going to disappear overnight. They've been around for a long time, big history. They provide good services that we use in our everyday lives. So if you bought really quality stuff or investments and you didn't get emotional, you'd be absolutely fine right now. That being said, you would have gone through a roller coaster. But if you did nothing, you would be better off than you were before the pandemic started. So that's a very powerful statement. So if you got emotional and wanted to sell when the market was low back between February and March area, it's very hard to time when to get back in. You might see a little rise in the market and then a slight pullback, and you're like, you know what, I don't want to get back in. And it's a very consistent message that I'll tell you every time we talk about this, which is timing the market is virtually impossible. You might get lucky once or twice, but if you want to, put your future, your financial future in the hands of you trying to time the market, which there's thousands of investment professionals all over the world that can't do that. And they're a lot smarter than all of us when it comes to numbers and markets, but it's just impossible. I always use the analogy, if I have something wrong with my health, I don't just Google it and say, you know what, I got it. I mean, I go to a professional, I go to the doctor, because that's what they're trained to do. We're on your side as advisors. We're not out to get you. There's no hidden agenda, at least not with me. I like to educate my clients and really help them, because all it takes is one big mistake in the market or in investing that could cost you a lot of time, a lot of money. So basically, if you stayed invested in quality investments that you own, you would be absolutely fine. Building wealth, I always say, is not a sprint, it's a marathon. There's no get rich quick scheme. Day traders might get lucky here and there. Somebody might get lucky on a company like Tesla. That's a whole different conversation, but that's just a good example. You just don't want to put all your eggs in one basket. I would never recommend doing that. And if you hear stories of somebody, that's invested in one company or anything like that, there's a lot of luck involved, because it's not a good long-term strategy. Slow and steady wins the race. And, there's a lot of little analogies that you can use or sayings that definitely have a lot of merit. And, this year really highlights the stay invested mentality when it comes to your wealth and building your wealth, preserving your wealth over a longer period of time. So, if you saw your investments drop more than you would have liked to, that doesn't necessarily mean that you are in the wrong investments per se. I think that if you were uncomfortable with how your portfolio acted in a time like that, then I think it's time that you rejig your risk, because the risk that you take definitely is highlighted when the market goes down. The psychological, there's a lot of psychological studies that have been done, and individuals are 3 times more likely to be emotionally impacted when their portfolio or investments go down than when they go up. So, it's risk reward. I mean, again, another cliche saying, but it is very true. If you take more risk in the market, longer term, there's a higher probability of making more money than if you weren't taking as much risk. And I probably will do a video on risk itself, but risk doesn't necessarily mean a bad thing. And, the more risk you take, the higher the chance is that you can grow your money over time. And I see a lot of younger clients that have RRSPs or TFSAs invested in GICs or just straight cash. That gives me the chills. And I get it, you've got to be comfortable with your risk, but there is risk in doing nothing as well. Inflation, time value of money. Look at the price of a chocolate bar. I remember when I was a kid, we could buy a chocolate bar for 50 cents or so. And now it's, I don't know, $1.50, $1.75, depending on where you go. But that in itself is inflation. So, of course, it's uncomfortable to go through any time like we went through from a market perspective. I have money invested personally in the market as well. It does make you feel uncomfortable, but that's when you go back to the basics. You remember what you're doing, why you're doing it, and sometimes it's best just to not look. For those who look at their investments on a daily basis, it's going to drive you crazy. So please don't do that. But it's a long-term thing. It's something that, it's like working out. But my financial fitness, that I talk about is exactly like that. Like, you go to the gym, who goes to the gym and sees somebody working out, and then they're sitting in the mirror looking at their biceps. It's not going to happen overnight. If you want big biceps, you want, a big beach body, it takes time, and it's no different than building wealth. You have to stick to your strategy, be diligent, be disciplined, and long term, you'll start to see results. And this is also what advisors do. So think about it again, keeping on the fitness topic. Personal trainer holds you accountable, they're accountable to help you achieve your fitness goal. And it's no different than an advisor. There's things I'm accountable for. There's things that my clients are accountable for. We partner up and we try to achieve your long-term financial goals. That is really the very high level of what an advisor does with their clients. So, if you have a month or two of shaky markets, why would you let a month or two ruin a long-term strategy that you have? Because 2020 was a phenomenal year to highlight, stay invested, don't get emotional, contribute often. So the clients or the individuals that are contributing on a monthly or bi-weekly basis, it was a great year for that, because you were also buying your investments in March or February, March, April, when the market was going down. So you would have picked up some cheaper shares or units if you're using mutual funds. So over time, that's a great strategy, and it's called dollar cost averaging. So this was a great year to highlight how that can benefit your long-term growth. And like I said, no one has a crystal ball, and this is a great time to reflect on the year. And we're always going to kick ourselves for, I should have done this, I should have done that. We should have bet the farm on even a Canadian bank back in February, March. There are a lot of cheap investments, and there's still cheap investments out there. But human beings are resilient, markets are resilient, and they look years down the road. So, we got through a very difficult market period, and, not saying everything's going to be fine going forward, but this was a great year to reflect on how the market performed, how it affected us. And then maybe you want to make some changes, maybe you don't. But I wouldn't rush out to make changes when the markets get spooked a little bit. I watched some shows, real estate shows, and they were kind of knocking investments and things like that. You don't hear them talk about it anymore because they've come back up. It's just like real estate. It's part of your overall financial situation. Investments, real estate, a business if you have it, cash, artwork, whatever you have, it's a combination of everything that makes up your net worth. And I would never recommend somebody only invest money or only buy a house. It's a well-rounded situation, and you're also spreading risk. So that's a good segue, talking about the shows, into the media. I just want to mention to the media, we saw a lot of negative headlines all throughout the summer, even back, or obviously more back in February, March, April. The market's tanking, sell everything. One piece of advice is stop reading or watching the media and letting those dictate what you do financially, because there is a lot more to what they say. They're also trying to sell content. They're trying to sell viewers. They're trying to get you to watch their stuff. Let's be honest, we all watch the news more than ever. I watch it for business purposes and also just to be updated on the pandemic. But there's a lot of negativity, and quite frankly, I'm sick and tired of the news, because all it is negative stuff. So just keep that in mind. And when you work with a professional, we take all of that out. We give you the raw information of what markets are doing, what companies are doing, and most importantly, what you're doing, because you're the most important person when it comes to investing. I could tell you to do a million different things or give you education on a million different things, but it may not make sense for your situation. And that's why it's important to talk to somebody, get to know somebody, so they can really understand you and help you over time. So, this wraps up an interesting year. I'm pretty excited that I started this YouTube channel. So hopefully, you're enjoying some of the content. I got my lighting situation fixed. I haven't had too many haircuts. I don't know how many of you have had too many haircuts. I've had a lot of Zoom though. So really, this was the year of Zoom, not so many haircuts, and getting outdoors. And for me, at least, talking to my family more than ever. So I'm excited. Tomorrow's New Year's Eve, and I have a Zoom call with my family. So I hope everyone's finding creative ways to enjoy, your days, your holidays. 2021 is looking to be a better year. Keep in mind, we're all in this together. So, think of other people when you're out. And as I always say, thank you very much for your support and for tuning in. So until next year, stay safe, stay healthy, and stay invested. Happy New Year, everyone. Take care.